Okay, so I'm going to talk about some of the investor options that are out there in comparison to what it's like to invest in a small business. And this can be a discussion that we can have with high net worth individuals or regular individuals of not so high net worth. But in any event, the vehicles that are out there really don't compare with the small business buyouts that have superior returns. And I'll show you how. If we go through the bottom to the top, the ones that are the absolute worst in returns, you can see the progression here, and it's sort of like, well, all right, we get up to a certain level and then we leapfrog over everybody and wind up buying a business. And I'll show you how that works. If you have bank accounts, for example, that aren't paying much more than CDs, paying 1%, and demand deposit accounts paying nothing, and money market accounts paying 0.005%, well, you pretty much want to get out of a bank. And so the second move you're going to make perhaps would be into government bonds. And maybe you have a brokerage account and you're going to put some of that money into a 2% coupon or a 1% or a 3%. So you do have some value there that is safety. Safety has a 2% coupon. And then, of course, you have government bonds, and they are going to pay a bit more. They're not quite as safe, but they have the full faith and credit of some of the biggest corporations in America. So you do have your 5% coupon on some of those. And then you have the stock market, which, if you're good, you can top 12% returns, maybe 10% to 12% over time. It's volatile, it's subject to bear markets, and you better not have your money ready to take out when you're in the stock market. So, gold. Gold is something you keep when you're about to go into Armageddon. You're not necessarily going to want to cash it out every turn, every stock market blip. You're not going to want to do anything with it, actually. You're going to want to keep a small amount of it in your portfolio in case the world comes to an end. So, after that, what do you have? You have commodities, which is gold is a commodity, but then there are other commodities. Oil, we know right now, is a bit off. Coal is a bit off. Steel is always off. And it's not the best investment. That I can't even put a return on it, but I do know that if you wait long enough, you could probably buy a coal company on the public markets for real cheap, and it might turn around eventually. That's the good news. And then if we move up to REITs and some of these other funds, funded investments, they have some high dividend yields at 10%, even though the real estate is worthless. And the hedge funds can get up to about 15, maybe 20% if they're that good, and most of them aren't, especially Madoff, and he's a negative 100%. So a mezzanine fund, yes, that's almost as safe as junk bonds, and junk bonds actually pay a good return. They could pay as much as 20% equity. Good luck trying to get in because they won't let you in. Well, maybe they do if you have $1 million chips, but we're not all in the position to be investing in mezzanine funds as we aren't in private equity. And of course, if you put your money into either one of those, you might wind up seeing it 10 years later. So nobody really wants to put money into these funds except for perhaps pension funds or big institutions. Would they do 33% IRR, the way their internal rate of return, such as what they're proposing they would like to do? Not usually. So I wouldn't expect 33% return on a private equity fund, especially one that's $5 billion in size. Sometimes they do, most of the times they don't. So I'm going to put you guys all into something that we think is much more lucrative, and that is a small leverage buyout, where you can be a significant owner in a company that's throwing off maybe $1 million or $2 million in cash flow. And the reason you can do it is this: you have an 8 to 15% cash on cash return, you have profit distributions, you've got your own proportionate amount of ownership, and even perks and expenses and consulting fees can be worked into the deal. It's a negotiated deal. It's not something where the private equity puts you into a 20% category and gives you the smallest amount of a share that you could possibly get. And on top of that, the small business investor is going to get a 5 multiple earnings on his money at the end of all this, and that could be a substantial amount, because what we've done is we've leveraged the company to begin with, and in 5 years we may sell the company, and if that happens, you're going to get a multiple of what you put in. So we can't obviously project all that, but we can indicate that sometimes these internal rates of return can be astronomical, and if I'm one doing it on my own account, they have been astronomical. They can be incredible returns. In fact, you can get in many cases, the investor gets a high double-digit yield right off the bat without any other compensation included into the calculation. So the internal rate of return, cash on cash, can be as high as 15% or 20%. So anyway, those are the types of things that I don't think everybody's aware of when they're looking at investments. And of course, I don't expect people to put their life savings into a buyout. They can go bad. They aren't necessarily perfect as anything else in this world is. And so you do not want to put all of your eggs in that basket. But if you have some interest in making a small investment in a company that is significant in the small industry, small market industries, then you will want to consider a small buyout of this sort. So if you're interested, talk to us about it, and leave your name, give me a shout, and we can tell you exactly what's going on.